Hey YouTube, welcome to the course Introduction to Stocks and Lesson 3, which is Understanding Equity Risk by Rithik Tangella. So, when we look at stocks, their risks associated with each company can be classified into two major categories: systematic risks and non-systematic risks. Systematic risks are generally a more larger and broader category of risks, which is basically affects the entire market or market segment or like overall economy. So when we look at this, we can look at like geopolitical risks, such as the trade war between the U.S. and China, which was an increase in taxes, vice versa between both between both countries, which not only affected the economy overall, but also affected each company within that economy, as in U.S. and also in China. And then we go to non-systematic risks which are inherent to that specific company and or industry. And we can look at this such as anything that occurs, a specific product that the company sells, or it can goes to specific executive decisions from the people running the company, and so on. So let's first get into systematic risks. For example, we can look at economic risks such as an economic market collapse. For example, during the 2008 recession, we saw several companies go out of business. And we can look at, during 9/11, unfortunately, when the terror attack happened, not only was it devastating for the people, but it was also devastating for the economy because it kind of destabilized not only the government in a way, but also the economy overall because investors were less inclined to invest in that market at that time due to them thinking that it was going to be unstable. Then we go into inflation risks, which is basically the value of currency, but stocks are generally a good hedge against this because companies can market themselves or market their products in a way to increase consumer prices to kind of curb this inflation. And then we look at market value risk is when the overall market turns against your own investment. For example, when you're investing in a specific company and a certain event happens, such as the market collapses, well, a herd movement occurs, which is basically a large portion of investors would likely pull out their investment, therefore dragging you down too, which the company would decrease in stock price. So your overall position or initial capital would be decreased. And then we go to the geopolitical risk. As I was stating in the previous example with U.S. versus China, trade wars and trade war tensions, we see when we increase taxes overall in specific sectors, we see that the economies are overall affected. Now we look at non-systematic risks, which are specific to industries or companies. We can look at poor management decisions. For example, if a public pharmaceutical company decides to drastically increase the price of one of its products, now, and which is unwarranted, and the overall cost of the actual product is substantially increased and it's disproportionate to the price reflected, this would be a poor management decision because less people would be inclined to buy that stock and also almost seem unethical in a way. And investors would be less inclined to invest in that stock due to the public outrage or also the decrease in revenue that company might incur later on. And then we see narrow sector factors, which is niche companies in specific industries. For example, let's say there is a luxury product company that specifically sells luxury yachts, and it's public. And the government decides to increase or set a steep tax for luxury yachts. Now, this would specifically harm that industry and that company, which is a narrow sector factor, because it specifically affected that company due to their own specialization. Now, when understanding overall these companies, we need to understand that their uncertainty exists, and in order to be a good investor, you must kind of weigh these systematic and non-systematic risks, determining when a good time is, if the company is, too specialized, how its financials are, as we'll cover in later videos, and also is the timing overall a good time to buy, meaning is the political status of the country and in the international or national spectrum, is it healthy? Is it inducing investment and also for other people investing. But it's also up to the individual investor. It's up to you to decide, if a company is actually worth the investment. And it's through thorough analysis that one can actually understand if a company is worth it. And we'll go into later videos on specific financial ratios to determine if a company is worth the investment and what type of strategies one should have. But for now, you should understand the two types of main categories in risks for companies. Thank you guys. Subscribe to my channel and wait for lesson 4, which will be uploaded soon.